Shah, founder, CIO, CEO, Sameeksha Capital, and he's been a close watcher of IT now for so many decades. He looks at the market, individual stocks as well, but he's got a keen eye on IT and the mood, the pulse, and the investor view towards IT. Bhavin, your first take on the IT numbers so far, and what does it tell us for FY27? What should shareholders, investors do?
Yes, I think it is certainly disappointing, although not unexpected outlook for the sector. If you compare it to say a year back, what people were looking for FY26 is clearly a step down in expectations and growth outlook for FY27. So obviously because of the confluence of factors, with the whole the AI-led improvement being the a new and very significant factor at play. And so I think for the investors, there is not much to play with. Definitely not in the large cap IT. In a small mid cap, there might be, some very, very select opportunities, where there might be a company specific growth story playing out even amidst all this, because, for a smaller company, it is easier to still grab some new business and still deliver growth. But even there, if you would have noticed, the companies that were growing at say 20% are now people are happy to if they are saying 10 double-digit growth. So yeah, it is a tough space to be an investor, and it's in a portfolio. I would suggest very low allocation, if any.
Low allocation to IT, if any at all. So for this kind of growth, say a 2, 3, 4% kind of a top line growth and a little better on the EPS front, what is the appropriate valuation for large cap IT companies to your mind?
I mean, the way I look at it is, I like to say that to invest in a large cap IT, one would, these are liquid names, at least still some fair bit of stability in their cash flows. So let's say you are okay with 11, 12% return. And then if the underlying growth is, let's call it maybe 3, 4%, including some currency benefit, as you said, then you have to get down to low teens or 10, 12 kind of P multiples for them to be attractive investments.
Even taking into account the dividend yield, you're saying the appropriate valuation multiple should be low teens? Because there is significant derating from here on. Already IT companies are at say 16, 17 times. But you're arguing for lower valuations.
Absolutely.
Okay. What about companies like a Persistent, Coforge, which are growing well? But as you pointed out, these were companies growing 20% plus and now perhaps will grow at 15%. Are these companies also trading at expensive valuations to your mind?
Absolutely. The whole sector needs one more valuation reset. We had one valuation reset. We saw a bit of a rally, but I think that rally is not going to find support. If you just notice overnight, the major tech companies in US, Meta, Microsoft, they all announced large job cuts. And we know that Indian IT services companies are essentially, they have been growing through the growth in headcount primarily over a long period of time. So when the whole industry is shrinking in terms of number of people required, then obviously it's not a great place to be.
Yeah. No, absolutely. Bhavin, morning. Prashant here. Good to see you. There is, and that's the point. I mean, high tech is, of course, getting impacted first, as someone said. Well, right. But everything else also perhaps gets impacted. But at the same pace or not is the question. From you've named names like Sonata in the past. I'm not sure if you still have that in the portfolio. I've heard names like First Source as some of the smaller companies, perhaps more agile, more AI first in their approach. Is there a way to look at any of these names as opportunities, maybe on the product side, or not just pure services? What's your sense, Bhavin?
Well, yeah, product, for example, we have some of these listed companies in the banking software space. They might have some bit of defensive position, especially in that space. But again, one has to look at individual opportunity. We don't have any investment there, but it's something one could think.
Do we have him?
Then there is the if you talk about pure IT services companies, again it is case specific. We don't own Sonata, we do own Mastech. It is corrected a lot. I think company has shown a very strong growth in order book, and so we are continuing to hold it. But we won't go aggressive there either.
So you're not buying the dip on Mastech as well, a stock that you like and you believe in the long-term story.
He owns it, but
Yeah.
Yes, we do own it, and we are we have confidence in the management to deliver reasonable growth, especially considering the valuation.
Any other stock that you own in IT or you're looking to add?
We own stocks in IT related areas, healthcare IT, for example, companies like IKS, for example, or even Sagility. Again, we won't build more aggressive positions there or increase our positions there, but we think that these companies do have the ability to take advantage of AI. But they also face disruption. The shrinkage in how much customer would be willing to pay for the same work, and so on and so forth. So that pressure also will be there. But overall, we think that if they adopt AI well, then they can still grow because their end market is fairly large and still have room for growth.
All right, Bhavin, appreciate you joining in. I believe you had a late night cricket game, but made it in the morning for the interview. So appreciate you joining in and giving us that quick analysis. Have a good day ahead, and we chat up soon.